Everybody, Dave Putz here from JKP Holdings. Alongside me, of course, Mr. Nathan Turner, as always. Hope all is well with you. We're just mentioning the rain. We're getting some crazy rain recently. We're having some rain this afternoon too. So not sure how I like this thing. Hopefully Halloween for us kind of gets better. But we'll see from there. I wanted to kind of see what your plans are. Man, I know we'll be seeing each other in a few days. Yeah. I know that Note Expo is coming up. If you don't have tickets and you want to get them, reach out to us. We'll set you up. But from now, I think, what's been new in your world? What's been going on? I knew I've talked to you a little bit, but I know you've been kind of dealing with all these conferences.
I have, yeah. It's been a busier time than it has been for a long time, actually. The traveling is coming back online, which is good and bad. I'm surprised at how much I've missed it, because it was getting to the point there where I just was getting tired, and it wasn't. I don't know. It was just tiring more than anything else. It was always useful and productive, but just tiring. Yeah. But I'm surprised how much I missed it. I'm actually, and I've talked to a few people now. They're going to Note Expo, and it's interesting how excited everybody is. And I just kind of get that feeling that everybody's just really looking forward to it and getting back together and getting back with a group of people that can talk notes.
Hey, we do miss that conversation of like, okay, I don't got to teach the basics at point, or even, your family who's like, I don't want to hear anymore. Like, we talk about something else, like they bring up politics or coping. Like, listen, I'm going back into real estate,
Yeah.
So for me, I've been dealing with a lot of bankruptcy problems, a lot of stuff there. We have a couple of cases where the trustee, I'm sure Aaron reached out to you, is stuck at like, they're open on Tuesdays and Fridays from 1 to 2 o'clock. It's like, what is, like, you can't answer an email or take a phone call? Like, I don't get it.
I don't like bankruptcies. We've been over this. I don't like bankruptcies in general. Yeah. They're a pain in the butt. I don't like dealing with them. They're time consuming. I'm not a fan. Yeah. But that's me, like I know you get bankruptcies all the time, and so you must like them. I just
I enjoy the payment stream that comes with it, right? I enjoy that the extra money, right, as I call it. And then when you sell it, you can sell with a P&I in mind. But for those couple of years, you're getting that extra payment. Are you doing any kind of evictions right now? Any kind of with that in mind?
I am. I've got a couple of evictions that have started. I'll tell you more about it next week. I've got a mediation meeting actually next Friday. During the conference, I'm going to have to miss the first couple of hours to do this mediation meeting. I've got one it's in Connecticut. Oh my goodness. Connecticut's tough enough to begin with, but then this guy is just like, he's crazy and it's an interesting situation. Anyway, I'll fill you in next week, but the guy is awesome. Stay tuned, everybody. Just out there. So we'll see.
And for me, we're seeing a lot of inventory. I'm seeing a lot of non-QM stuff recently. And we're seeing some portfolio come through. And I'm curious what's going to happen. I'm going to have a call with some friends this afternoon about some stuff to see where they're going with some inventory that they're going to be releasing. They're just trying to release it at the right time, make sure their portfolio and time with the capital they need. They don't want money sitting there. They want to keep recouping it. So it's interesting. Now, your experience, you bought CFDs and first and whatnot. Have you bought a lot of seconds?
I think I've owned 2 seconds in my career, and one was by accident, one was on purpose. One, I think we didn't know it was a second. And then the other one, we did know it is second, but we also owned the first. So that was okay.
Oh, that's a nice situation.
So that was an interesting one. That was in Hawaii. That's the only Hawaii note I've ever bought. And that's also a tricky state to deal in.
Yeah.
And in fact, we ended up doing like a deed in lieu, just because the court system is so slow. It's ridiculous. But anyway, the other one was an accident. It worked out, but I didn't intend to buy a second.
Yeah. So It's weird because I bought a few seconds non-performing. I bought some performing, bought some CFDs, but didn't dive into it like you have.
Mhm.
But I've met a lot of really good second investors, and they're really awesome to talk with.
Yeah.
At times I can't relate to them because their process is a whole lot different from ours, even though they're still in the same space.
Yeah. I find the second space really interesting, and I can see how somebody could be attracted to it, but it's
Yes.
not my preference. It's not something I want to do. So I'm always interested to talk to seconds people and get their perspective and why would you go seconds instead of a first? I much prefer it, but I'm always curious, and they've always got good reasons. So I'm excited for our guest today.
Yeah, I think for me is understanding their process, right? And
Mhm.
understanding what they do.
Yeah.
I just don't understand sometimes what they do to get into an asset, what matters, what doesn't matter to them, right?
Mhm.
And what they avoid, what they don't avoid. So it's really cool because you talk to any first investors, and each one of them has a little different spin on what they do and what fits their box.
Yeah.
And for whatever reason.
Yeah.
So it's cool to have that conversation. I encourage everyone, talk to as many people as you possibly can. Don't stick with one person. I'm not saying that one trainer is bad. I'm just saying is you get different angles of things.
Yeah.
Me and Nathan have been on a call before, and you're like, well, I like it for this reason. I'm like, I don't like it. And we differ on opinion.
Mhm.
We're neither right or wrong. So awesome.
Yeah. So curious to hear, we've got Daphne Wilson here too, and a seconds person. So we're
Well,
interested
welcome,
to kind of
Daphne.
pick
I
her brain and
appreciate
figure
it.
out what's up with seconds.
Welcome, Daphne. Enjoy.
Thank you. Thank you. Thank you for having me.
Our pleasure.
Absolutely great.
So Daphne, can you give us a background, how you got started, what channels you went down, what tree you came from? For new investing, everyone comes from a tree. Share your background a little bit.
Sure, sure. My background is actually corporate technology. So a computer scientist for over 25 years, worked for a lot of Fortune 500, Fortune 100 companies in the regulatory and compliance space, predictive analytics, big data, whatever you want to call it. That's my background. And I had just gotten burnt out. I had a great career, excellent salary, but was just burnt out. I remember sitting in my office. At the time, I was working in the Sears Tower, now the Willis Tower, and looking out the window onto Lakeshore Drive. People were out in their boats and, jogging and rollerblading and having lunch with friends. And I'm sitting here slaving over a hot computer and just thinking to myself, there's just got to be a better way. I'm just ready for something different. And so I figured real estate would be a way to retire myself. Didn't have a real estate background other than, owning my own home. And so I went to a real estate seminar that they have all over the country. And the gentleman opened up the seminar by talking about the top 10 or 12 ways people make money in real estate. And he mentioned note investing. And, he said, hey, you can buy the mortgage instead of the property, and people will make their monthly mortgage payment to you for the next 15, 20, 30 years. And I thought, that's how I'm going to retire. That's it right there. So I went home, I researched, and I just really liked what I learned, and decided that that's the route that I was going to take. So
and this company, they're real estate focused, right? So they didn't even go into it besides just that brief introduction.
That was it. They focused more on rentals and fixing and flipping. That's what the seminar was going to be about.
Mm-hmm.
But I wasn't interested in that. I wanted to know more about this note investing thing. And, once he told me it was going to be about, fixing and flipping and, rentals, and I said, no, that's not, I'm interested in this note investing.
Hmm.
So yeah, it took me a year to to find someone that, teach me business. So I hung in there. I started investing in seconds because at the time, well, and I guess in a sense still now, I'm highly risk averse. So I do not like to lose money. And I thought investing in seconds did a few things for me. One, it was a price point that I could afford when I was getting started. It was, I didn't have a huge chunk of money in the bank to buy a first mortgage, the $200,000, $300,000, $500,000 first. I didn't have that kind of money. So seconds were more in my price range. And then also it minimized the likelihood of me having to take over the property, which was something I had no interest in. So my focus became buying a delinquent second mortgage where the homeowner was current on the first mortgage and had never been late. Because, a loan meeting that criteria, it's not very likely that a homeowner is going to lose their home over a $30,000, $40,000 second mortgage if they can work out a payment that they can afford. So I was really attracted to that. So the price point and also the less likelihood that I would have to take over that property.
Cool.
Really
So you have the traction, right? That's the hook.
Yeah. Yes.
So this is 2015 or so. So now we're 6 years removed from there. I'm sure you've interacted with other second investors in the space, right? We're a very small space. Share who you dealt with. Who are the people you look up to? Who gave you your education? Who gave you your knowledge? Who mentored you?
Oh gosh, and I still have these mentors today. Bilal, I credit him with teaching me this business, basically holding my hand and, being there when I called and text, and Sherman, Arnowitz, Keyhole Financial, very instrumental and, made himself available to me, as I was going through different scenarios. Also, Mike Kelly. Oh man, he's such a straight shooter. I just love Mike. If ever I just want just the straight, no chaser version. I mean, if I say something that's, he thinks is insane, he'll say, Daphne, that's insane. He doesn't sugarcoat it. I just love it.
Yeah,
and the thing with
Mike's
guys,
awesome.
Yeah. And the thing with these guys, I could have one question. I'll ask each of them separately the same question, and I'll get 3 radically different answers. And so, my response is always a hybrid because they always have a great reason for, for what they're sharing. Yeah.
And we've talked about this before in First too, like you say, we can talk to different people and get different answers, and it's the same in seconds. And there are wrong ways to do this, but there are many right ways to do it as well. And so you've got all kinds of choices on what you can do based on your preferences and, your philosophy, whatever you want.
Yes.
That's really cool.
Oh yeah. And so there's also Sabrina Allen.
Oh yeah.
Yep. And let's see.
Man, you pick some of the best.
Oh, yes.
They're the goods. All those guys.
Yes.
Very good.
Jazz.
So it's weird, the second space, right? What people don't realize about this whole industry is very small. They get into it, and we've seen people like, oh, I'm going to go and broker. And you're like, listen, this isn't typical real estate where you can come in there and broker and no one knows who you are. People talk. It's so small. So seconds is a very different animal than first. And most people say, well, I don't know where to start at. What is it about seconds, besides the cost, that's attractive to an investor that may be getting in? Cost is probably the top one. It's a cheaper way to get into investing, and you can buy more than just the one.
Right.
What are some other advantages of buying in a second position?
The other advantages I see is, for me, I didn't want to have to take over the property. So if I didn't want to have to manage a property, I didn't want to have to evict anyone. I wanted to make sure that my whole model was cash flow. So I didn't want anything to do with the property. So, my criteria is always to buy a delinquent second, find a performing first, because that minimizes the likelihood of me having to take over the property. And that was really key for me. Another reason is the homes tended to be nicer and more attractive, because a lot of times people will take out a second to make improvements on the property, redo kitchens, baths, put a pool in the back, whatever. So the properties tended to be a little nicer, for that reason as well. So yeah, those were really the three reasons: the price point, the condition of the properties, and also the less likelihood of having to take over a property.
Yeah. And a lot of people everyone wants to get real estate, so they don't have the property, right?
Yeah.
And that, when you're in the first phase, you're worried about that. So that's a great point. That's awesome.
Yeah. There's a high likelihood, in fact, I think, and I may be higher than average, because I buy loans on vacant properties all the time. That's common for me. So I think my foreclosure, or not necessarily the foreclosure rate, but the rate of me taking back a property is like 50%. So it's very likely that I'm going to take back the property. So that if you're not interested in that, then yeah. And one way you can minimize that is by first on occupied properties. But for me, as long as the numbers work, that's all I'm really looking at. I don't really have a huge preference one way or the other.
Yeah, for me, being, highly risk averse, my first thought was, if I bought a delinquent first, even if it was occupied, I don't know if the homeowner wants to stay in the home or not. They could just be living in it for free, waiting for the foreclosure to happen. And so I just didn't want to go down that road. My goal was I just wanted to have money flowing into my account without having to do anything with any property.
Mailbox money.
That's it. That's what attracted me to the note space. That's what I came here for, But, for investors that are more hands-on, and the numbers, really work for you, then that's a great business model. But for me, I was just really looking to cash flow. I didn't want to spend a lot of time on my note business, quite honestly. I spend maybe about, I want to say, a total of 5 or 6 hours upfront on a particular asset. I get it, I get it back to cash flowing. I turn it over to a servicer, and then I'm done with it. It's on to the next one.
So you can be out at the lake jogging or rollerblading or whatever.
Exactly.
That's awesome.
So let's dive into it, right? For first and seconds, the collateral file are all the same, right? The assignments are all the same. The sellers are somewhat different sometimes, right? Some people, you can get second from certain people and sometimes not. One of the big differences we see is that in the first phase, of course, there is no performing senior lien or non-performing senior lien. Share how you do that differently. What is the difference between buying a loan that has a performing first or non-performing first, and how do you adjust that, and what do you look at for that? And you buy both?
Well, I will only buy a delinquent second if the first is current, and for the most part has never been late. So that's the number one criteria for me. So if the first mortgage is 60 days late, I won't touch it. And that's because I am very risk sensitive. So I am, really trying to be careful about, the loans that I pick and choose. So for me, that's the major criteria.
So how have you found supply from 5 years ago to now? Have you found a dramatic drop off there, or are you still finding enough deals to buy?
Yeah, I am. I am still finding enough deals to
Good for
buy.
you.
Yeah.
Oh, that's really interesting.
Mhm.
Yeah, one thing we've realized recently that second loans aren't being as created as often as they were in the prime days, right? We're waiting to see some kind of record of, the past year, how many second liens were created with people taking out the equity of their house with the values going up. I haven't seen anything either. I haven't really dived into look. But from what I've heard initially, there wasn't as many people taking the equity out into a second. There may have been. Have you seen any kind of update on that at all? Have you heard anything about people taking out seconds because they have equity because values are up?
Yeah, I have gotten a couple of articles that have come across my desk and people taking out the equity in their property. Once the property value started going up, the way they have been, people are starting to, take out home equity lines of credit and, second mortgages, which is a good thing for, for us.
Mhm.
Well, eventually.
Oh, I think we're losing her feed.
Oh,
There we go.
I mean, but yeah,
Jeff, we're losing your feed just a little bit, just FYI, just everyone know it cut out there for a second. But I'm glad to see that you're seeing inventory. I'm glad to see, because we've heard a lot of issues with seconds having an inventory struggle, right? First, in comparison to what we dealt with years ago, has definitely decreased, right? Not saying they're gone. We're seeing the inventory. We've seen more in the last quarter. And a lot of people I've dealt with in the past said, just wait till the first quarter, we'll be releasing more. So I'm glad to see the seconds have availability out there, and you don't touch anything with a non-performing first.
nothing.
Okay.
Yeah, if the first is not performing, I won't touch it.
Do you buy, sell, or finance seconds?
I'll pretty much buy any second. I mean, really, I've bought some very dirty paper. I'll buy up stripped seconds that were stripped in a Chapter 13 bankruptcy.
Yeah, really?
I'll buy those all day.
Yeah.
Cool. That's really interesting you mentioned that. It's like, for example, and this is one of the reasons that I steer clear of seconds, but maybe I'm just looking at it wrong. So for example, I've got a first lien on a property down in Florida, and we're completing a foreclosure on that only because the second lien holder won't respond. I'm more than happy to pay them off and just be done. I've already got a deed in lieu from the borrowers, so I can get the property, but it's still encumbered by the second. So I have to go through the whole process of the foreclosure just to clear off the second. Wow. And if they would just call back, I'd happily pay them, but instead they're going to be ending up with zero. So I look at that and I go, why would you put yourself in second position where that's possible? But if there's equity and it's paying, then I suppose.
Yeah. Is the second lien holder still around?
Yeah, and I think it's a bigger bank, and maybe it's just it's a small balance, $15,000, and maybe it's not worth their time. I don't know. I'm
okay. So it's a bank. Okay.
I can't figure out why they're not just returning an email. I
don't know what's cheaper too. You could look to do a quiet title too, and just remove them that way and get them to respond.
That's right. Yeah.
We're moving through it. I've got Aaron on it, and we're moving through it, and we'll get it done.
Shout out there.
Yeah. For me, it's really frustrating because they won't just come to the table and accept a payment. And in my mind, they would rather get stripped and just be, washed out rather than talk to me and take a discounted payoff. But anyway, it blows my mind.
Yeah, that doesn't make sense to me either.
Yeah, strange. So it's for me, my biggest thing is just that takes more time. I don't want to take more time. I want to do it now. Anyway.
So we had a question regarding strips in seconds position, right?
Yeah.
Can you share what that means and how often do you face it?
So when a homeowner files Chapter 13 bankruptcy, the bankruptcy court wants to know whether or not the first and second mortgage is, whether it's covered in equity. So the equity position of the property is what kind of comes into question. A lot of times what a homeowner or their attorney will attempt to do is they may say, well, the home is underwater. So the homeowner owes more on the home than what the home is worth.
Mm-hmm.
And so if they have a second mortgage, then there's not enough equity in the property to even partially cover the second. Now, there's only $1 in equity that's needed in order to keep the second mortgage lien intact on the property. Mm-hmm. But if the homeowner maybe gets an appraisal done or whatever, and they determine that there's not enough equity to even partially cover the second mortgage, then they'll petition the court to strip the lien off of the property. So then the second mortgage becomes unsecured and is considered unsecured debt, similar to credit card debt. Mm-hmm. So if the homeowner actually completes the bankruptcy plan, which is typically a 5-year plan, then the lien will be taken off the property. So that's what it means for the second mortgage to be stripped.
And how often have you seen that?
I didn't know that.
Well, it happens quite a bit now since, home values have increased, it's less likely to occur in this market, but it, it happens quite a bit. But the great thing, about that is when you're doing due diligence on seconds, that's one of the things that you want to be mindful of is, what is the equity position of the property? Mm-hmm. And you determine what your equity buffer is. So what's owed on the first, the value of the home, the unpaid principal balance on the second, how much above that do you want to be? 5,000, 10,000, 20,000, how much equity, would you like to see above the first?
Interesting. Yeah, I didn't know that that second lien still existed. I thought it was just completely wiped out. I didn't know it became unsecured. Learned something new.
It's like a personal debt then, right? You can't foreclose on it, but you still can collect on it.
Yeah.
Interesting. So when those kind of things happen, do you have remedies to fight that?
If it's close, then you can get the property appraised, and you can dispute it. But in some cases, back a couple of years ago, you pretty much know that the home is underwater, or it's so close. Once the first mortgage, once you add in legal fees and things like that, you're just too close to argue it, basically.
We've been in situations where we've knocked out a second, not stripped it, but knocked out a second foreclosure. Been doing it for 10 years now, and I've probably done it a bunch where the property value dropped and we go to sell at auction and the second gets nothing, right? And you look back and say, boy, I wonder who bought that second. But I would, from our experience doing this for as long as I've been doing it, those assets that are underwater are priced usually much more aggressive, or it's just cheaper to buy because of the fact the equity is missing. So I would presume right now, those assets are probably at a prime cost. Would that be fair to say?
Yeah, that would be fair to say. I mean, the foreclosure and the bankruptcy are really two different scenarios.
Mhm.
So for me, it would be extremely rare if I bought a second mortgage on a home that was the first was foreclosing, because my criteria right out the gate is that the first has to be performing, and not just newly performing, but it has to be performing for years. I mean, they basically have not missed a payment in years. And so that would be extremely rare for me. Now, a person could file bankruptcy at any time, even though they're current with the first mortgage. So that could happen at any time.
Of course.
So before I purchase, I am looking at the equity position of the property. And if the home is underwater, they're current on the first, but the property is, is underwater, then, I got to think about the likelihood that I may reach out to this homeowner about paying the second. And then that's the straw that breaks the camel's back. They get afraid, they file, Chapter 13. And, now they're petitioning to strip the second, which I know the second will probably be stripped because I already knew the equity position before I purchased the loan.
Right.
So then I have to be okay with it being stripped. Doesn't mean that I'm not going to get paid in the bankruptcy. There's probably a 90% chance that I'm still going to get paid through the bankruptcy court. I'll be paid as an unsecured creditor, but because most of the time I am the largest unsecured creditor, I'm going to get a larger share of that payment from the bankruptcy trustee. So
That's interesting.
yeah, so I'll still be getting paid on that note through the bankruptcy court.
Cool.
Which is why I'll buy those loans.
Sure.
Yeah.
Once you get that bankruptcy court, you can still collect on that loan. You can still collect on that debt because it's still a personal debt that person owes you. It's just not secured to the property any longer, and that lien is released and whatnot. Cool.
Yes.
So how do you source deals, Daphne? Because I know I've had people ask me before, do you have any seconds? And I say, I don't even ever look for them. So no one ever sends them to me.
So before you answer that though, I want to let them know that giving away sources is one of our biggest things we try to share, right?
Yeah.
And there's a couple of reasons why we don't. We talked about last week, but we'll give some generality is I can give you the fact Daphne's name, but you're not going to reach out Daphne, cold call or call email her and say, give me assets. She's not going to have the same relationship she does with me, right? And when you reach out, they're not going to trust who you are. So it's a networking relation. So we get this question all the time, right? Where can we get assets from? Even if I give you the name, which I don't often do because that's our bread and butter, the relationship's different. But with that said, where do you turn in general to look for assets?
Oh gosh, I have bought directly from banks and credit unions. I do have relationships in certain states, but I also will buy loans from anywhere. So I different brokers. Also, I mean, I've bought loans off of Craigslist, believe it or not.
Wow.
Yes. The due diligence is the same. I still have to check everything that I would normally check. But anywhere, actually.
Really interesting.
Yeah, attorneys, real
Really
estate
cool.
attorneys, asset managers.
So the due diligence, that's I think the other thing that separates the first from the second investor is what kind of due diligence and the extent. I know from the first perspective, we're very interested in the property and the value because there's a very good chance we're going to take it back. I almost never I will glance over the borrower, but I really don't pay much attention to the borrower at all.
I don't care.
Right. But I think in seconds I've heard, and so I want to confirm that that's much different. You're much more concerned with the borrower.
Absolutely. Absolutely. I, other than the equity position of the property and whether or not it's occupied, now for me, I like for the property to be occupied by the borrower. Some other investors in seconds don't really care about that. But, you know, for a person investing in seconds, we are concerned with the borrower paying us. So we want to look at, we want to get as much information about the borrower as we can, you know, just, you know, what their credit history is, what they're doing with their credit. So we're trying to assess the likelihood that they are able and willing to pay.
And how much do you look at the credit score versus the credit history?
I don't really care too much about the credit score.
Yeah.
I'm mostly concerned with the credit history, because if they're delinquent on their second mortgage, something has usually happened to cause that. And so I'm not expecting them to have a 700 credit score.
Yeah.
So, you know, these are scratch and dent loans. And so I, you know, that's what I'm expecting. But if I look at the credit history and I see a lot of medical debt, you know, that tells me, okay, something has happened. And, you know, this is about how long ago it was. And, you know, what is this borrower's, you know, occupation? What are they doing? Are they trying to reestablish their credit? What are they doing as of late? These are things that I'm very much concerned about. You know, do they have children that, you know, also live in the home? Have they filed bankruptcy before? You know, what's the likelihood that they may file bankruptcy again? Are they repeat bankruptcy filers? I mean, anything and everything to do with that borrower is important to me, not so much as the property. I bought seconds on properties that were in very economically depressed areas, that there are vacant lots all over the place. But if there's a, you know, a lady and, you know, she's 62 years old and, you know, she's lived in that house for most of her life, she's not giving up that property, you know, and so I'll buy that loan. It doesn't matter if she's living in a war zone, because I know that she's going to pay. She's not going to give up that house.
I like
So,
that. Yeah. I did in past years, I did a lot more origination. So I would look at credit reports a lot more often. And that's one of the things that I found is if there's a bunch of medical debt on there, oh my goodness, I don't care. That has so little to do with their capacity and ability to pay that you know, wipe it off. I don't even look at that. I say, oh, medical, okay, great, and then keep going and see what else there is. That's really interesting.
It's interesting you say that, right? Because for us, I've been told to pull a credit report when buying first, but it's like more of a curiosity than a need, right? I don't care if they can pay or not. If they don't pay, I'm in the driver's seat, right? We were talking about this in our mastermind the other night, is that second position liens are also a little bit riskier. You may have to put it on the shelf for a couple of years till things just kind of come around. Where first you're taking action pretty much right away, and typically you don't put it on the shelf. I think for me, seconds is a great situation to get involved with, because you can buy a bunch. And if something goes wrong with one or two of them, you have the other ones kind of balance out the deals. But I think for me, seconds, like what Nathan's saying, is we're all about the property. And it's not that I want the property back. It's that I can understand, come from a real estate background, that real estate's all I'm really going for. And to evaluate a person, it was difficult for me because we've seen news articles of evictions not being able to happen and people buying brand new cars, not paying the rent payment. So their ability to pay is there, but their desire is just gone. So when you're going through that due diligence process, you're pulling the O&E, of course, you're pulling that, you know, the title, the credit report. Is there anything you focus it a lot in on those credit reports or even the O&E that you drill down on to make sure that this loan is what you're looking for?
Well, I'm looking at what the borrower is doing with their credit. And I'm trying to determine the likelihood that they may file bankruptcy. So if I see that they have over I don't know, 80,000 in debt, then it's, and maybe they've never filed bankruptcy before, then it's a good possibility that they may file bankruptcy.
Mm-hmm.
Well, if I have to take that into consideration, when I'm determining whether or not I should buy this loan. So if I look at the credit report and I say, wow, this person has an awful lot of debt. They're current on the first mortgage. They're keeping up with that first mortgage payment, never been late a day on it. But they've got almost 100 grand in debt. Mm-hmm. They may file bankruptcy if they get a letter from me demanding that they start paying the second. If they do, how much equity is in this property? What's the likelihood that I'm going to get stripped? Okay, so that's kind of how these pieces are fitting together. I want to know who the borrower's employer is. Are they still employed? Are they still working? So these are the types of things that I'm looking for when I'm looking at the credit report, not so much as the score, but I'm trying to determine what is their debt load, because I don't know what their salary is. But from the credit report, I know what their debt load is, and I can ascertain the likelihood that they may try and offload that debt in a bankruptcy. Now, if they recently filed, or if they are in an occupation that prohibits them from filing bankruptcy, then it's, okay, this is great.
Game on.
Yeah, I've had that happen before, where I've had a borrower that, had city contracts, and she could not file bankruptcy without, her whole business going down the drain. So, it was very easy to work out something with her because bankruptcy was not an option.
Mm-hmm.
Well, most people also don't know, and you hit some good nail on the head here, is that, government military employees, if they start their FICO score goes down, they can lose security clearances.
Yeah.
So, yeah. So
That's
it's a big deal that these people cannot start missing. If they miss 1 or 2 payments, they got to catch up because they can lose their job in the military. It's crazy.
Yeah.
In the due diligence process, do you pull BPOs, or how do you come up with a value, or do you just kind of go off of what you see, because it's a weighted measure? You really, really care about the person, not as much about the property, but you have to care a little bit. What do you typically pull to kind of review value?
Actually, I don't necessarily need a BPO, because I just need to have an idea of the equity position of the property. So I'll maybe compare what I get on Zillow and, some of the other sites. I'll look at, home values in that area, and then, look at how much the person owes on their first mortgage. And so that gives me an idea of the equity position. So I don't need it to be exact, but I have a threshold. So I want to at least be able to say, okay, they bought this home way back here. This is what they owe on it. They've been living in it for 15 years or whatever the case is. And, this is what the home values are, and based off of, 3 bedrooms, 2 baths, and, in this neighborhood or whatever. That's good enough for me. If I say, well, they've at least got $20,000 in equity or $30,000 in equity, that's good enough for me, because I only need $1 in equity. But if I've got that much, I know that I'm good to go.
Yeah.
So that's really all I need. I don't need a BPO or an appraisal. So
a few people on our feed are asking Daphne about your beginner's course. I know we have some, you have some, and the reason we connected was I had another investor who shared getting on a phone call with her, and she's like, "Oh, I've worked with Daphne," but I've heard a lot. I'm sure Nathan has too, with a lot of education programs out there, either being expensive or not, but they miss a lot of the key things that I shake my head at. And one of the things that I heard was about, tape headers or whatnot. You talk about that stuff. So, they're nice enough to post your beginner series into the feed, but I think a lot of people miss out on some of the key things to understand what they're looking at, right? We can understand the investment side, but we get to take data in and they see all these different fields and never, ever are they the same column headers, it seems like.
Right.
It's amazing that people don't either A, understand it, or B, get educated, because some of those fields are a huge deal, right? We talk about the difference between the last payment received and the paid to date are completely different dates, and people get confused. So I wanted to give you kudos because I was amazed when talking to this person about how I've heard so many other programs out there miss those things and not share it, and it's crucial. With seconds, when you get a tape of seconds, is there something on there that besides, a lot of times you don't get the balance of the first. You have to pull a credit report to see that. Is there something on the tape of the seconds that you see that you focus on that is a big thing to you that you need to know more about? And if it's missing, what do what's missing that you need to know?
The first thing I need to know, even if I don't have the balance of the first, I need to at least know if it's current.
Gotcha.
If it's 30 days late or 60 days late or whatever, that's what I need to know. I need to know the status of the first.
Sure.
And is that on the tape? Is that usually part of that tape?
Yeah, it's usually on the tape. Even if the balance, the UPB of the first is not on there, the status of the first pretty much always is on tape.
Okay.
Yeah.
So most of what we see is mixed bag, right? We'll see first and seconds. And to tell you the truth, the ones we do see that mixed bag doesn't include anything. And typically they don't have a balance of the first. It's like, there's a first lien, this is the second, so figure out yourself. And it's like, okay, wait a minute. I don't even know what's going on here. So I can't make a bid offer on the second without doing more due diligence. And for me, it's not worth to dive into that because it's not worth the homework for us. When you're pricing out a second, do you guys use a bidding model calculator? Do you guys go off of, scenarios?
Yes, there is a somewhat loosely defined pricing model that, takes into consideration kind of the bigger things, like the status of the first, what I want to say, the equity position of the property, whether it's a judicial or non-judicial state. Let's see what else. Those are really kind of the big three there.
Okay.
Yeah.
Interesting. And before we get to the question I posted on here, are you going to be attending kind of no conferences coming up at all? Some people asked about that. Are you going to be, what conferences will you be at so they can connect with you and network with you?
I always go to the Note Expo and also the Paper Source Note Symposium. I haven't heard anything about Paper Source yet, though.
Yeah, we had them on. We have. Well, I know Tom's done some stuff recently, but I know that they did some kind of like 20-person, I think it was, mastermind kind of thing. So they're not doing a full conference this year like they have in the past, from my knowledge. But yeah, so guys, me and Nathan will be there. Daphne will be there as well. This is one of the big questions. I'll let Nathan ask. This is one of the questions I think most people ask us, other than the general, right?
Yeah.
So go ahead, Nathan. I'll let you ask it while I.
And this is a good question. I think this is everybody when they're getting started. This is the question. Is it appropriate if they're asking how much should a brand new person to note investing expect costs to be? Like how much money do you need to get started?
To get started.
Yeah.
Okay. Well, that's a good question. When I got started and even now, my costs are actually very minimal. You know, I don't view my note business as like a business, like a traditional home-based business. Notes to me are an investment. You know, it's like me investing in anything else, stocks or crypto or whatever. I just happen to, you know, have assets that are notes. I have other types of assets as well that I don't make like a whole business out of it per se. They're just assets that I own that are part of my portfolio. As such, I have, I think my business expenses amount to less than $500 a year.
Wow, that's
Awesome.
Yeah. So, you know, I don't have a website. You know, I do have, you know, a domain for my email.
Yeah.
I have you know, a mailbox for my business. I have a, you know, an 800 number, you know, fax, things like that. But I think in all total, it's less than $500 a year, you know, for my business. And then, you know, then the assets that I purchase. So since seconds are so inexpensive for the most part, on average, I spend about $2,000 to $8,000 per asset when I buy a note. I've bought notes for less than that. I've bought notes for $200. I've bought notes for more than that, you know, 17,000. But for the most part, they're $2,000 to $8,000 per asset.
Wow.
So,
and what size are those? Well, like what's an unpaid balance on that second?
it's about anywhere from 30 to 60,000.
Okay.
Cool. So everyone out there, you can get involved in the space. One of the costs that goes involved in any note purchase is servicing. Do you typically service yourself or you hand it out to a third-party servicer?
I always hand it off to a third-party servicer, always. That's what keeps me in compliance, you know, with, you know, federal and local, you know, regulations. And it's what puts this whole thing on automatic pilot for me, quite honestly.
Yeah.
You know, once I turn it over, I don't have to, you know, I don't have to think about it anymore. I do work out my loans with my homeowners directly. So, you know, I'm working it out with them. I help come up with a payment arrangement, you know, whatever amount that they're going to pay to reinstate the loan with me, which is usually what I pay for it. So that's the first order of business. If I pay $5,000 for an asset, when I reinstate it, I'm going to have the homeowner reinstate it for what I paid for it. And then cash flow to monthly payments for, you know, for the next 15 years or however long. And so that's, you know, once I come up with that, and I have the homeowner sign it, it's notarized, I get a voided check, I send that off to the servicer, they handle it after that, and I'm done and on to the next asset.
That's awesome.
It's it's a different space, but it's all the same space, right?
Yeah.
You know, we've been involved with the first space and CFDs and whatnot, and buying second to us is performing. We buy it and let it go on autopilot for us, right? We don't mix with that. One of the questions we get oftentimes is when there's non-performing second, what is your typical process to get it rehabbed?
Okay, that's a great question. So one of the first things I'm going to do is I reach out to the homeowner, usually a couple of times. They're going to get a hello letter, obviously, and and then they're going to get a notice of default or delinquency. And I'm going to encourage them to reach out to me. I may reach out to them. But when I talk to them, there's a couple of things that will happen. I've reached out to some homeowners and they may say, well, gosh, nobody's contacted me about this loan in forever. I've been waiting for somebody to call me. I'm ready to pay, and so then they'll just pay. Or, quite a few times, I'll reach out to a homeowner and then they'll say, we don't want to be bothered with this second. We're just going to pay the whole thing off and be done with it. And so that happens. But then, more often than not, the homeowner, because they're current on the first, they're not trying to lose their home. So they're like, okay, what can we do here? And so, I have in my mind what I would like. So I'll offer that. If that's not something they're able to do, then I'll request their financials. So, here's a worksheet, provide your, your income and expenses. I may require other information like tax returns and, paycheck stubs, things like that. And then I'm going to take that information and I'm going to come up with usually 3 options. And I'm going to talk to the homeowner about each of those 3 options. And I'm going to say, which one is going to work best for you. And, let them choose that. And once we come to an agreement, I'll draft it up, send it off, they sign it, have it notarized, and then send it back. And that's usually how that process works.
That's cool. So in those 3 options, do you usually have a favorite?
Yeah, the first option is always is a discounted payoff.
Okay.
Pay the loan off for less than what they owe. And I make it a really sweet deal, right? Maybe they owe $50,000 and maybe I paid $6,000 for the loan.
Yeah.
So it's easy and like, this is great. So the discounted payoff is always number 1.
How often do you, in the first place, we do it a lot, we just file legal. We don't even bother with all those headaches and conversations. How often do you guys just file legal to get the ball rolling on that side? Do you do that often?
I usually will do that after about 8 weeks.
Okay.
So I do have a fairly aggressive timeline to get the loan back to performing. And one of the ways to do that is to start the legal process early on. Because of course, legal will create a sense of urgency to get it resolved. But I will try and reach out a couple of times because I have had experiences, like I said before, where the homeowner is like, hey, I've been waiting to pay. Nobody's called me about this loan in, however long. So I do give them a chance to come to the table on their own. But after about 5 weeks, 6 weeks, then I will engage legal.
Yeah. That's awesome. So we're asking everybody with everything that's been going on the last year and a half and everything, pre-COVID, post-COVID, I don't know if we can say that quite yet, but maybe, right? What's your crystal ball? What do you see in the near, midterm, and long-term future for this business? Are you expecting to see a lot more defaults resulting in more inventory, or what do you think?
I think that what I'm thinking is that as people, focus on getting back on track with their first mortgages, after all of this is over, the forbearances and all this kind of stuff, and they focus on getting back on track with the first mortgage, that may be other debt will kind of take a back seat, because even if a person is struggling financially, maybe all the resources they have are going towards keeping that first mortgage current.
Yeah.
Right.
So there may be more second mortgage delinquencies as a result of that, and other delinquencies, student loan debt, and credit card debt and other things may take a back seat to keeping up with that first mortgage, which is fine, because that creates more opportunity in the second space, because basically, they're trying to do what we want them to do anyway. We're trying to keep them in their home also.
Yeah.
We're not interested in taking over the property either. So the fact that they are working towards keeping that first mortgage current, we're just saying, okay, this is great. Let's get you back on track with your second, and just finding out what they can do, because there's so many creative things that you can do in the second space. Even if a person is only able to make a $100 payment for the next 4 months, maybe month 5, that can be $150, or maybe we can gradually increase that, to a point where it's, a payment that, is the payment they actually should be making. So, we're able to really work with the homeowner on that.
Oh, that's great. Very interesting. It's always good to get the second perspective. In my mind, what I kind of finally came to is the first mortgage perspective is a shorter term, with the second being the longer term strategy. And that's not exact, and it's not, exactly how that goes, but that kind of idea where it's kind of a shorter term, longer term kind of approach to notes. That's how
flipping seconds is not very common.
Yeah.
So, usually you buy a shelf it, or you buy it, perform it, or whatever, unless you rehab it, right? So cool. Well, Daphne, I'm looking forward to seeing you just about a week from now, right? I'll be flying in on Thursday and whatnot. I love to see all you guys out there just talking. Please do yourself a favor, introduce yourself, just say hello. We talk to a lot of people, shake hands and say who you are, and say how we maybe even talked on the phone before. So I look forward to connect with Daphne in person down there, and just get together and just sharing information, right? It's our time to kind of get together and talk. I haven't been on a conference this year yet, so I'm really looking forward to getting down there Thursday evening or so, and then spending some time with you guys. Hopefully everyone gets down there safe. If you are looking to go down there and you don't have a ticket yet, let us know. We'll get you a discount code, and just sharing ideas. So awesome. Daphne, I thank you very much for joining us on a Friday afternoon. Hopefully you don't get too much rain out there, or if you've already bypassed you, that's awesome. I hope that everyone out there has got a lot of nuggets out of here. I know Nathan and I have. It's something we're always learning about. So I appreciate you guys coming on, Daphne coming on and joining us. And if anyone has any questions, we'll make sure to get in touch with you. I think they're tagging your series on the feed, so that's awesome too. So
great.
Very cool. Thanks so much.
Thank you.